Oh, good morning, traders. This is Blake, and you are listening to the Face Show, and you're not hearing Dale this morning. There's a hurricane that is passing through California and through the Western United States, and so Dale is out. He was worried that his internet might be out, and he went to go stay at his in-laws. In a different location where. So anyway, long story short, I'm here, and so is the rest of the team. And so we're going to be filling in for Dale today. I think he has an interview coming in, Zach. So I'm going to probably end up handling that a little bit later. But we're going to get started with this week. Just take a look around and see that the market is actually recovering a little. You're going to see the equity markets, the S&P's bounced off of really key support. You can see we're also actually taking out previous lows, which kind of held us at the end of last week. You can see it right here. It's allowed us to push up. I'm gonna bring in Ryan and K-Man here shortly, just to hear what they have to say as far as like some of the headlines have come out of China. Because we still have a really big week this week. I know China had out their loan rates, which I think they came out a little bit better than expected. Anyway, you're seeing a bit of a recovery in risk assets globally. Not only you're seeing in the S&P, you're seeing in the Nasdaq, but if you take a look at some of the other markets, like the Nikkei's bounced from channel support as well. You got the DAX, it's up nearly 1%. You can see it's bouncing from that key level of support there. We're back at 15.7, which is a big deal. But overall risk appetite to start the week has improved. Now, we do have a really big week this week. Like I said, we have Jackson Hole at the end of the week. We have the BRICS meeting. If you listen to the week ahead video, the BRICS meeting starts on Tuesday, goes from Tuesday to Thursday, so 22nd through 24th. So I'll ask the guys here in a second what they're all expecting from those meetings. But overall, I want to show you like kind of the overarching theme here with the dollar. The dollar has found some really critical resistance. I think it's channel resistance, horizontal resistance. We've gone a very, very far distance in a very short period of time. And I think it was a bit of a stunner for the market. And as I explained last week, that this blue line that you see here, this horizontal line, I consider that the bull bear line in the sand for the market. So you can see the dollar index, and if you look at the bull bear line right here, it is at 103.75. That means basically while we're below 103.75, you have to be bearish, or at least have more of a the risk is bearish. While we're below there, especially after traveling so far, so many technical levels, you have to kind of remain defensive. We get above that at the end of the week, or by the end of the week, that could be really, really bullish for the dollar. And I think it'd provoke a lot of short squeezing in the dollar. You'd probably see a lot of long liquidation in the euro as a result. Now, a multitude of reasons could really push this, that narrative. And I think it would be, one, you walk away from the BRICS meeting saying, okay, there's been no new developments there. One of the big risks right now is that that there could be an announcement where they start to offer some sort of alternative currency to the dollar that they use amongst themselves, which excludes the dollar. Is just it would just prove that the rest of the world is really trying to move away from dollar dominance, if you will. That would be one thing that could really sink the dollar. But the flip side is, if there was no announcement, you could see the dollar really rally. The other thing could be a really hawkish tone, not only from Fed Chairman Powell. You could see a rally, beyond this level if he's relatively hawkish. But we'll have to see. So by the end of the week, the dollar could make a really big move, especially in a week where it's fairly illiquid. So anyway, I want to bring in Ryan. Good morning, Ryan. How you doing?
Yeah, morning, Blake. How you doing?
Good. Hey, how'd the Hammers do today, or this weekend?
Yeah,
Excuse me.
yeah, we did all right yesterday. Beat Chelsea 3-1.
Yeah, I was gonna watch the highlights, because that's what I tend to do. Is I tend to watch highlights here because a lot of the matches are happening when I'm not around. So I didn't get a chance to watch. I was going to do it. I spent the day yesterday with family, but that's great. They won. Did you go? Was it a
Yeah,
local?
I was up there. Yeah, late kickoff. Didn't get home till about 11 o'clock last night. Straight in on the desk doing the options. But yeah, it was a good game.
Oh, awesome. So hey, what's been happening overnight? I know that there's been a lot of Chinese rhetoric. There was information out on their loan rates, and we've got a big week this week. So what are you looking at as far as moving the markets today?
Yeah, well, they cut their LPR rate. Well, one of them, they cut the 1 year by 10 pips, left the 5 year unchanged. Bit of a surprise that they didn't do more. A lot of the market was expecting 15 pip cuts, and the fact they left the 5 year unchanged as well. But then it falls into their message that they're not going to go for a flood-like stimulus. That's been their message all along. And even then, the Securities Council, or MOFCOM, or whatever you want to call them, announced more targeted measures, if you know what I mean, ground level measures rather than big fiscal monetary policy measures.
Yeah,
So
it sounds like it could be a little underwhelming, right?
Yeah, I think the market is getting a sense that they're dithering about it and not taking a strong hand to it. But then that's China's way. They haven't gone down the route of QE and massive, huge rate cuts and throwing a kitchen sink at it. But they are, as I say, tinkering with bits and pieces at the ground level, which perhaps that may have more an effect than just going big stimulus. So the market's always going to push its expectations on what a country should do. But when you've got a country like China, you listen to what it does do, not what it should do, especially when you want to trade it. And they've been intervening again this morning, or mopping up, as it was called, rather than intervening wholesale in dollar yuan, dollar China. So we need to keep an eye on that as well. And we're in one of these situations where they keep intervening. They're intervening now in their session, European session, US session. So they are drawing a line, but they're saying something different. They're coming out with messages like, oh, well, the currency's moving normally. We're not bothered about it. But then they drop messages in that they expect not to weaken as much in the second half of the year. But if they're doing lots of intervening but not getting the result, that's when you got to worry they will come in with a big stamp, and just give the market a little nudge to say, yeah, you want to take us on, you better be prepared for what we've got to fight you with. And I think
it's interesting. You look at the China CNH 50, and I know that we're at a pretty critical fib level here. You can see we broke a little minor trend line, so I don't know how much weight I'd put on that, but you can see Chinese markets just really aren't responding to all this. I mean, the Hang Seng, obviously it's Hong Kong's a little bit different. You got the Hang Seng just rolling over. CNH 50 is just trading heavy as well. So yeah, we may be seeing responses in the FX space, and the US dollar CNH might be maybe double topping here, definitely finding some resistance. But it's surprising to me that the Chinese equity markets have been less responsive here. So
yeah, and that's a lack of trust, isn't it? Like we're saying, the market's saying, well, what are you going to do about this situation, lower growth and everything? And until they really put their foot down, market's got to do what it wants to do.
Well, another big move that we're seeing right now is we're seeing, obviously, and I'm gonna be a little Captain Obvious here, but even U.S. yields are actually ticking back up today. But really strong move in the bond market over the course of the last couple of weeks. So, what do you make of this move in the yields this morning? Because it's obviously screaming, and the dollar is not responding to it, which is also, I think, a little fascinating. It is against the dollar yen, but the dollar, as a whole is kind of rolling over. But what is driving yields this morning?
Cage on that one?
Yeah, I think it's more a case of again a bit of liquidity on the one side, but then we are going to have the longer end treasury issuances as well this week, the 20 and the 30s, and markets are a little bit worried that they may underwhelm. And you see the 30-year is pushing up against the prior high from October last year. And I think that's what keeps the markets up. We are not seeing much weaker data, right? And if you look at front running the events a little bit into Jackson Hole, and I was mentioning that on the I reckon on the flow show, I did mention it. If you look at the S&P 500 compared to Jackson Hole last year, we're about 300 points higher. And if you look at the unemployment rate, we are still around there as well. So I don't think the market is now expecting a dovish tone from Powell for a starter. But then what we're seeing today, and one of the reasons why the dollar isn't following, I think the market is preparing that BRICS summit. Just preparing for any possibility, because there's talks going on, and we've seen Saudi Arabia is a bit of a candidate to join it, probably not a full inclusion into the BRICS because they don't want to let the West go, but it's all a bit of a risk factor. And I think that if anything would happen on that BRICS summit, it would maybe a bigger event than the Jackson Hole actually. But
I hear what you're saying.
I don't think they are going to talk about a new currency. It doesn't seem like insiders say it won't be on the agenda, but they can say something about transacting more in their own local currencies. But then I think the big one that we need to watch is what's going to happen with Saudi Arabia and UAE. India, Brazil are not too warm to expand the BRICS right now. But you never know. You have China, Russia, they will be pushing hard, I reckon.
Yeah, I believe that I think you're totally spot on there. And at the end of last week, and I know I mentioned this during the week ahead video as well. I was pulling off all my dollar longs at the end of the week last week, just in preparation and knowing we've gone this far this fast. And I think you're right. It's a big risk. I was reading over the weekend. It is not on the agenda, obviously, but that, making a dollar announcement. I mean, if they're going to make a dollar announcement, I don't think they're going to telegraph it either, right? They're not like, this is one of our talking points, and we want the whole world to get ahead of this right now. Like if I was, if I was the BRICS and I was part of that leadership, I wouldn't want to, this would be a surprise. This could be one of those black swan moments, for the markets. So
I don't know if they don't want to pre-announce it. Why not? I mean, it's all a game of geopolitics, I don't think they will really surprise. They have already been talking about that, right? And it's actually ongoing because Russia sells oil to China and it's paid in Chinese renminbi, right? But yeah, I think the biggest shock or immediate shock would be that one of those two, and especially Saudi Arabia, would at least show closer cooperation, and I reckon that is what we see right now. And the fact that the yen is not following, it's yields, but on the other hand, if you strengthen the BRICS, Japan being more part of the Western bloc than the Asian bloc, really, that may weigh on the yen as well, in a way. And I think it's just more psychological preparation that we're seeing right now. That is what I would say about this BRICS thing and the moves that we see right now. Because on the China's LPR, they were actually underwhelming because they only changed the 1 year 10 BP. They didn't even change the 5 year, which is the main rate to
Financing, yeah.
financing loans, right?
Mhm.
And that is actually not a great thing for reinvigorating the economy if you don't cut the 5 years. And that apparently has been done clearly with the weaker yuan in mind. So that's a bit of a underwhelming move on that side, I reckon.
Well, let me ask really quick. Steve, are you here? I know you're here, but are you here?
No, mate, I'm not.
Hey, Steve, how are you? Welcome back from holidays.
Thank you, mate.
So hey, do you I'm not gonna hold your feet to the fire here, because I know you've been out and your focus hasn't been the market so much, but I don't know how much catching up you've done over the last, few days or whatever, 24 hours. Okay. So do you have any opinion on let's start with the Jackson Hole, coming up this next week. What do you think about the Fed chair and not the Fed chair specifically, but well, I mean, what do you think about Jackson Hole? Do you think there's going to be any commentary as far as there was actually some comments over the weekend from what's the Wall Street Journal, Nick Timros? He was talking about there's an article on the Fed discussing R squared. I haven't had a chance to dig into all that just yet, but there's been some talk about maybe some shifts from central banks. Do you think we're going to get anything exciting over the weekend or over this next week from the Jackson Hole Symposium?
It is likely that we're going to get some statements. So definitely the market is going to be paying very close attention, and you know how it is. It's all about monetary policy shifts at the moment. I mean, the whole investing planning is totally based on it. Everybody's worried because we're obviously in a period that things can change and can change fast. And the market is looking into dissecting, even small statements and, get something, important out of it. Now, personally, I wouldn't be betting on that, but it is definitely a risk.
All right. Yeah. That okay. Well, there's definitely going to be divergent central bank policies moving forward.
Yes,
Ryan,
and that is what's going to be moving FX, right?
That definitely. Now that we've come to I want to say terminal rate. I think we are near terminal rate with most central banks. Now
in the grand scheme of things, we are. I mean, plus or minus 25 or 50 basis points in the grand scheme of things won't make a big difference, right?
Yeah. No, I agree with that. Ryan, which central bank do you think of the G10 are going to be the first to really, move here as far as diverge away from each other? I mean, you could say, obviously the Bank of Japan, but let's just say the Bank of Japan is really stuck over the next, few months as we go into 2024. They just continue to, mess around with this yield curve control, but nothing major. Any other central banks you feel like, whether it's the Bank of England, the European Central Bank, which one do you think is going to flinch first?
What, in terms of cutting rates?
Yeah.
I think you've got to potentially look at your Antipodeans, RBA, Kiwi, those sort, because they seem to be ahead of the pack of seeing their economies slowing and slowing significantly, obviously with the China influence heavy there as well. So they could be a target. The Bank of England as well, because, I'm never wholly negative as many people are in the UK, but if we are going to see effects, they're likely to be stronger here from all these rate hikes than maybe we'll see in the US. So if that manifests over the next few months, then probably the Bank of England is going to be one of the top candidates for cutting first. And then you're going to see some big moves in yields and the pound and whatnot.
All right. Well, how about you, K-Man? Where do you feel that where's the divergence going to be in the months ahead?
I think the people, I think the ECB will be forced to stop sooner than what the market thinks. We've seen the PPI this morning in Germany coming down pretty hard. So I know I'm not part of the consensus, but I think the risk is that ECB all of a sudden says like, all right, we're there. We are going to continue to let these exceptional measures roll off, a bit like the Fed. You know, they can stop the rates, but then let QT go on in the background. And yeah, I reckon the ECB may be one, but is it going to create the biggest move? I don't know. I'm with Ryan. I mean, if Bank of England says that that's enough, then sterling is going to probably get hit more because of there's less liquidity, and the market is traditionally loves to sell something. So and the sterling is always prone to a sell-off. But for as long as that doesn't happen, I think actually ECB's may surprise. Because they're expected to continue, and they may surprise saying that they are already there where they want to be.
Now, I have to admit that the euro has been quite strong. I mean, it's been much stronger than other currencies. You can really see it in obviously the euro's in this ascending channel. As we approach the 200-day moving average, but you can really see it against like some of the anapodians, like the euro Aussie. This is a chart, and we've had a lot of discussions about the euro Aussie over the course of the last couple weeks in the ForexAnalytix chat room, or a couple weeks, I should say, over the last week in the ForexAnalytix chat room. This is what the ForexAnalytix chat room looks like, by the way. And I actually started buying the euro Aussie, this last week, and I want to show you guys something, because a lot of people look at the euro Aussie and go, well, we just completed a flag pattern, and it's broken out, but it's been going up for so many days. Why would you buy it here? I'm actually already starting to stick my toe in. The reason why is I'm going to go out to a weekly chart. I want to show you guys this. This is post-COVID, right? This is the spike high. You can see it right here, right? And then this is the low following, after the COVID lockdowns. We're at the 50% retracement, but not only that, we're actually in breakout territory. 127% extension of this last consolidation, 50% retracement. This thing breaks out to the upside. It's going to be. I don't think we're going to match what you saw during the COVID lockdowns, but I think we could, see back into the 170s. And I just think the euro just looks really good. You look at it against like the Kiwi, it looks pretty. You see it's breaking out to the upside there. The euro Canadian even, is holding up pretty well. You just like the euro looks decent. So obviously I'm kind of with you, K-Man, as far as the ECB goes. I think they could be the first one to flinch, but I guess if they don't, the euro could continue to look good against other things too. Yeah,
I mean, of course, if they don't, then this continues. And this is what we've been saying for months, right? The euro is doing better on the crosser side, and that keeps euro dollar in range. But will it continue? I don't know. I mean, I'm not saying this week. I don't think, because Lagarde is in the hole as well, right? I don't think this week we will hear that much from them. But they must look at those data in the European zone, which are on balance weaker than for instance in the US. And if you look at the short-term EU and US differentials, they are at lows, or we are at the lows since February, and you look at the 10 years for the short term. I'm looking at the 2 years, but the 10-year as well. The one that you show there is at lows since February, March. So that is keeping the dollar on the better hand. Versus euro, because we have seen the setback from 112s. But on the other hand, I mean, since the ECB is still expected to go on further, I mean, that keeps euro crosses better beat, especially when you look at the antipodians which are affected by China as well, and an economic downturn is going to affect them more and more rapidly. So that is keeping those euro crosses up.
Yeah, and I do want to mention Christine Lagarde is scheduled to speak on Friday at 3 p.m. Eastern, which is an hour before the market closes. And just a little bit of heads up for those of you guys and gals that are keeping a very close eye on the euro. Hey, we got about 5 minutes, and then I know Dale's not here, but we have Zach Mains is here. I'm gonna, even though I don't really know anything about Zach, I'm gonna spend a few minutes with him doing a bit of an interview. So make sure you all stick around for that. I think he discusses Elliott waves and equities. So I'll have him show whatever charts that he brought. But we got a few minutes before he comes up. Remember, this is the last couple of weeks of summer. I still expect a lot of volatility here, but I want to go around the horn really quick, with our group and just see what's on everybody's radar this week. So since we just heard from K-Man, Ryan, what are you thinking this week? Where's your attention going to be this week?
I'm going to be looking closely at the PMI data that comes out on Wednesday. We get the whole round of global PMIs.
That's going to be a lot of PMI data is coming out.
Need to see if there are going to be some further holes dug, because we know manufacturing's in a slump, services circling the drain. Are we going to see that continuation lower? But you need to look at the activity overall, the activity, employment, inflation, because those are the key points. If you take the Philly Fed and the Empire, the two regional US numbers, both contrasting numbers. Empire fell when it was supposed to go up. Philly went up when it was supposed to go down. But what was the same in both reports was that employment was lower and the prices paid were higher. And that's what the Fed is going to keep an eye on for their rate hopes.
I mean, look at just going back to PMIs. I mean, Germany manufacturing in Germany PMIs came out. Remember, they dipped below 40 last month, and we were like, wow. I mean, that's a crushing. Those are crushing numbers there. So yeah, it's like, I can sit here and go, I can't imagine that getting any worse, but we've seen it go worse, right? So yeah, some big data coming out this week. What's that going to tell you for market participants?
Well, it's like all big decent data. It's gonna, it has the possibility of throwing around rate expectations. The market's getting on board with a higher for longer, soft landings, all that sort of stuff. So for the US, it's going to be a case of, does that data match up? If we do see a rise in the US prices paid measures or any of the prices components, that's going to add into the inflation picture, which we know jumped last month. So that's going to indicate maybe another month of rising prices. So then you've got to think, well, you've got to keeps the Fed on the hawkish side. For the rest, like you say, Germany, the other Eurozone countries, if the data softens there across the board, prices, activity, employment, then that's going to fall into Cayman scenario of the ECB maybe pausing ahead of where they think they might.
All right. Well, thanks, Ryan. K-Man, what are you going to be looking at this week? What's hot on your radar? I know you mentioned BRICS, but anything specifically?
Well, that is, to me, has the potential. I'm not saying it will, but it has the potential to be the biggest mover. If no agreement is made for more countries to join, then it's probably going to be a storm in a teacup, and likely CNH antipodians are going to go back down. And then secondly, the PMIs here. I think for change, I don't think that Jackson Hole will tell us a lot. So I would even put that BRICS as a potential mover above Jackson Hole.
Wow. All right. Well, that's interesting. And and let me ask you this: would you be focused? I know you said you're going to be focused on the U.S. dollar CNH. Would you be focused on any of the other BRIC countries' currencies? Like, I know you trade the rand; it's going to be in South Africa.
Yeah, the rand as well, right? The rand is I won't say living on borrowed time because it has already weakened the South African rand. But I think if they fail to agree upon anything, the rand is going to get a knock on the head again next week. Later this week.
Got it. Okay. Very good. Thank you very much. Steve, how about you? Anything that you're focused on this week?
Yeah, getting reoriented.
All right. That's it. But where's your focus going to be?
I'm definitely paying attention to yields. I think, we are at, new highs in yields, and they're going to be the big indicators of what happens next. So for the time being, that's where my focus is.
All right. Well, we'll be focused on yields with you. Hey, guys and gals, I want to thank you all for being with us today. Dale should be back with us tomorrow. I think the massive hurricane that was hitting Southern California and the rest of the Western United States, like for me, it's just cloudy out here, and we might get a couple sprinkles, and I think it's just weakening into a tropical storm. So my assumption is Dale will be back tomorrow, bright-eyed and bushy-tailed. I think we have Zach is here. Zach, I'm trying to promote you right now to panelist. So if you see any type of pop up, then come join us. And I'm just going to leave it at that. And I want to say thank you all for being with us today. But stick around if you want to hear some. Zach is here. Zach, you can go ahead and mute your mic. We're gonna bring in Zach. I've never talked to him before, but I think he's going to be talking about some Elliott wave patterns and equity markets. So I want to thank the team for being here. Thank you, Ryan, Cayman, Steve, and appreciate you guys.
Cheers, mate.
Cheers. And hey, if you guys are not listening to Ryan, Cayman, and Stelios when he's there at the Flow Show, make sure you're listening to them. How many hours ago was that, Ryan?
Too many. About 3 hours ago.
About 3 hours ago. So make sure you guys are all listening into the Flow Show. Oops. Here, let me get over to the webinars here. The Flow Show, you can find it right on our website. So listen in with Ryan, Cayman, and Stelios when you get an opportunity. They'll prepare you for your trading day there as well, especially for those of you that are in European or Asian time zones where you are not sleeping. So thanks, Ryan. And thanks, Steve.
Thank you.
All right. And Zach, how are you? Is it Zach Mans or Mains?
Good morning, Blake. It's Manus.
Good morning, Zach. Nice to meet you.
Nice to meet you. We've been on before, but good to talk to you again, Blake.
Dale's dealing with Hurricane Hillary. So he is out right at this moment. I think he was worried about his power being out, and he lives in more central California these days with his wife. So they were kind of worried about what's happening over there. So I apologize for the short notice, but I'm with you today. So tell us a little bit about what you do.
So Garrett, Patton, and I run the Stockwave service as well as the Metals, Miners, and Agriculture service on ElliottWaveTrader.net, and then we have a duplicate of the Stockwave service on Seeking Alpha. So we're part of Avi Gilbert's overall suite of Elliott Wave and other market services at ElliottWaveTrader.net. But Garrett and I really focus on individual stocks and looking for rotation opportunities between different sector ETFs. And then we, because we're looking at so many individual stocks and kind of looking at the interplay between those different sectors, it gives us a little bit of a different view by looking at all those parts of the whole. To what some of the other analysts might sometimes be seeing on the SPX or the other index charts.
Okay, awesome. Well, tell us a little bit about yourself and not specifically what you guys do, but tell us a little bit about your history.
So I was actually a history major at University of Maryland and got into the mortgage business, and in 2006 started to see that was maybe not the best place to be, and so started
great timing.
Started to look at other opportunities. I mean, 2003 to 2006 it was great, and then it started to get a little rocky, and I think I jumped ship before things got really bad there. And I decided that it would be a good idea to go into retirement planning and insurance. So I worked with MetLife for many years, and then as I was getting Series 7 and started working towards getting a CFP and things like that, I'm friends with Avi Gilbert now for going on 20 years, and he kept trying to get me to read this book, The Elliott Wave Principle by AJ Frost and Robert Prechter. And I kept telling him, no, I don't need to read it. MetLife has got this asset allocation questionnaire. It's like these 10 questions. We figure out what kind of mix of stocks and bonds the person's going to need to get them to retirement. And he's like, Zach, that was written by attorneys who just want plausible deniability when the market goes to pot. So he said, read this book. So finally I read it, and it just really made sense. Like the idea of how markets move based on human sentiment and emotions of fear and greed, and these repeatable patterns that have roots in Fibonacci just really clicked, and I could see the patterns, and it just really made sense. And I started studying it with him. And then a few years later, he launched his website. And very shortly thereafter, I started the Stockwave service on it and left the windshield time behind of going to people's houses to take a look at their 401ks.
Interesting. All right. Well, I'm assuming you brought some charts and kind of where your focus is. Did you bring charts this morning? Or did you want to show your screen rather?
Of course.
Yeah.
Yeah,
great.
I can show my screen.
Great. All right. Well, I'm going to go ahead and pass it over to you, and let me know if you can grab the screen here, and I'll let you know if I see it. Perfect. I can see it. Yep.
Perfect.
So tell us what we're looking at.
This is the S&P.
Okay.
And I and Garrett are viewing the S&P, I think Avi really is too, for the most part, as being a corrective move up, even though it got so close to a prior high and could still even maybe get one more push higher. But viewing this very much like the end of 2019, where this was a large corrective move, even though it came up so high that people start screaming that it's the renewal of a bull market. But seeing, some potential downside looming, and maybe even this is the initiation part of that move. As I said, Garrett and I are always looking for those rotation opportunities. So we try to look for where the weakness is going to come from and where the strength is going to come from. So if we are in fact going to get more than just a corrective bounce as a small wave 2 inside the start of a bigger move to the downside, we want to know what are those things that are going to be driving that push to a higher high. At least a higher high over July, not necessarily a higher high over 2021 or January 2022, depending on the different instrument. And if we are going to only get a pretty weak corrective bounce, or just a normal corrective bounce and then start to drop stronger, what are those early signs? What are where the weak link's going to come in, and talk about that. So I can talk about the S&P chart a little bit more, but I thought maybe you guys would like to jump in and kind of look at some of those sectors that we have our eyes on.
Yeah, sure thing. Why don't you show us what you got your eyes on?
All right. So first of all, probably the most bullish potential looking sector chart that we see at the moment that would be a big driver to potentially getting new highs is XBI. XBI has a really nice move off of it didn't make a lower low in October. It held a higher low in October, but then got deeper into March. But then since then has this really nice 1-2 setup, holding a corrective retrace to a higher low off of the March low. So that can be the finishing off the second half of a much bigger corrective flat structure off of 2022 lows. So particularly off of the low that we saw last week, there's really, really great risk reward in XBI. And for that to be one of the big market leaders on any potential push higher that we get. Certainly if it only gets a move up into the low 80s and then turns down to break that low, then that thesis is shot, and it could be, even though there's no clear pattern for this to have completed this larger degree B wave back here, you have a couple of lower highs since this high back in August. So this could turn and flip very, very bearish if it pivots under the 75 region at this point.
Can I ask you a question really quick with
Of course.
as you go through your analysis, how much do you factor in, like, since you're looking at, sectors, how much do you factor in, fundamental analysis into your technical analysis? Do you do any, or is it just purely counts?
A couple of years ago, actually right before COVID struck, we brought on Lynn Alden to consult with us in terms of fundamentals, and we really liked her approach. That was not kind of the standard look at certain balance sheets and the same metrics. She kind of has a very different angle that she comes at things from. And so we talk with her a lot, particularly when we have a couple guys that write articles for us, Levi and Jason. And so they consult with Lynn. And so they're making sure, and they're trying to find places of overlap of, what are the fundamental arguments for why we're seeing what we're seeing in the charts. I don't know off the top of my head what key holdings in XBI she's weighed in on recently that would be driving this, but it's all sentiment, and if you're looking at things kind of like reversion to mean and things like that, this is a sector that's kind of lagged behind. Because it's lagged behind in an Elliott wave standpoint, it's given us this 1-2 setup of something bigger off of that March low.
Okay, that makes sense. All right, thank you.
Absolutely. Please feel free to stop me at any time. Another area that we see some good potential strength is in ITA. This is aerospace and defense. It's very much kind of doing its own thing at many different degrees. And so we're looking for a swing higher, really as long as it holds that June low of support, ideally holding the 113s here that it struck last week and launching pretty immediately higher. So that's another area. We're getting very excited about the energy sector, but not quite there yet. In about a year and a half ago, in May of 2022, we started to warn about a larger degree fourth wave consolidation. That since morphed into a larger triangle once it got a bigger B wave bounce than we wanted to see here, and then didn't follow through on a C wave to a lower low. So should be coming down one more time, but making yet another higher low. But that's going to be, I'm showing the XOP chart as opposed to XLE. They're very similar, but I think the XOP chart is much, much cleaner. So if we can see a nice corrective retrace back down towards the 120 region, that has some real nice potential to head into the 200s over the next, 12 to 18 months. I have it squeezed in a little bit sooner. A lot of things that we look at on our charts are not necessarily for timing. We're trying to show the structure. And a lot of times I'm going to squeeze in the later part of the move where, specifically not showing it for timing. I don't think this is going to finish by January 2025. It could, but that's not what I'm going for. I'm just going for highlighting the structure, but want to show as much of that detail for context as I can.
So Zach, you're showing a lot of setups for a bullish outcome in these indexes that you're looking at. But what are you seeing anything that actually could suggest that we are more or less topping in the S&P and we might see a move back down below 4,000?
So those are the few areas of strength, and whether those are defensive plays or whether they run counter to the market, I'm not sure, or if it's just that those are things that drive a little bit more extension before the market turns really sour.
Sure.
But retail is another area that we are very, very concerned about. Retail did not make any even attempts at making higher highs over February. It made a lower low in October like the rest of the market, but that really looks like the lower part of a expanded correction. We call that an expanded flat, where the B wave, or in this case an X wave, makes a lower low or a higher high, which implies that there's a lot more pull to the downside because it brought this to a lower low, even though it was part of inside of this bigger degree correction. And then since then, it has 5 waves down and 3 waves up into a Fibonacci retrace level, and could be one of the really more aggressive sectors that heads down.
Oh, got it. Okay. All right.
So that's one of the ones that we're most concerned about. I think XLF has shares some similarity there, but it's kind of on the fence right at the moment, where it can count as the same possible 5 waves down and 3 waves up as this wave 1 and wave 2 in the start of the C wave already. But right now it's holding the potential in the 3350 region here to try for one more high in just this wider flat that we've seen most of the rest of the things in the market get. So, you know, this is not a high probability long setup to play for one more high into the mid 36 to 37 region. You know, as a scout play, you know, if you are more nimble, then with support at that 3360s, you know, it's good risk reward for that one more move. But I would just be looking at this more as a ability to reposition and target, you know, retarget the downside for this to, you know, the whole pattern to reset.
Yeah, it's hard for, you know, in today's environment, especially with rates where they're at, it's you look at the financial sector and it's like, man, I don't know if I could be long, you know?
Right.
So, right.
So those are kind of some of the more risky spots. And then also, I'm going to go to the SOX chart instead of SMH because SOX didn't split and SMH did. So it makes it hard to look at that on a shorter time frame. So semiconductors is another area. There's a few of the semis, and once a month, actually once a week, Garrett and I do a webinar, and we focus on, for the first 20 minutes or so of that webinar, we pick a particular sector or subsector and look at the sector ETF chart or index, and then we drill down and look at some of those key components and see which charts argue more in favor of you know, the pattern that we're seeing, and which ones are kind of outliers, and you know, what are the key drivers of that pattern structure. So very much like what we're seeing in the NASDAQ and the S&P, it looks like we could easily have a top in place to this larger B wave and be looking for a measured move or a measured move plus from the same move that we saw down for most of 2022 play out to the downside over the coming, you know, 12 to 18 to 24 months for a move to the downside. And this can easily be just the beginning of that move. We could even count a small 5 waves down. Maybe it gets another little 4 or 5, and then it gets the bounces the wave 2. But yeah, easily just the wave 1 start to this wave 1 of a bigger move to the downside. Now, I don't think this is really set up as like a crash scenario. Although, you know, this could be just as much, you know, a bigger move to the downside than most people saw in 2020 post-COVID, but it doesn't necessarily have to be as quick and violent as that. You know, it could easily stretch out much longer and be a pretty controlled, you know, slog to the downside, but, you know, really wears some people out and gets things really nice and oversold. So we get at least a big corrective bounce off of that low over the next 24 months or so.
All right. Well, that would be interesting. And I mean, the semiconductor index is obviously a big driver in technology. So, well, that's awesome. Any other big, you know, charts that you're really focused on right now that's like, you know, this is where I'm going to keep my attention really over the next couple of months as we head into the, you know, tail end of 2023?
So in addition to some of the bullish sectors, in terms of like that we talked about, XBI and energy and ITA, maybe also XLV, we like the shift to possibly back to a kind of inverse correlation where metals and miners are seen as a safety play, you know, could start to, as a risk off trade, could start to fill out again. This is a ratio chart of the S&P to gold ratio. And we see this possibly getting one more push up into the 238 to 240s to fill out the final push higher in this B wave, but it's not really needed. And seeing that ratio start to fall, which doesn't necessarily imply a specific direction for either gold or for the S&P, just that relative to each other, that gold would be gaining in value. But when we do look at the metals charts, and not just gold and silver, but also copper and platinum and palladium, they all have really good looking structure. I'm actually going to go to the back adjusted because there was a pretty decent sized contract roll that I think skews the look of the regular futures, the continuous futures chart. So I have a few, well, just really one alt on here. The yellow is just, we got forced into this wider expanded flat, but as we talked about with the XRT chart, when the B wave of that larger degree correction made the lower low, here you have the B wave that made a higher high, showing that the upside pull underlying in the metals, particularly gold here, is much, much stronger. The alternative is just that was an extension of a larger wave one. And so we could get a little bit more of a retrace in the larger wave two as A, B, and a little bit more of a C wave to come down into some of these fib support regions. But that's really not needed. If we start to get over the 1960s, then we probably do have a bottom in place and can start that third wave up in the metals.
Do you think that third wave will take us to all-time highs then?
I do. If we zoom out here, again, I switched to the back adjusted that doesn't have all of the prior data, prior wave counts on there because of that contract roll that we had. Was it back here? Yeah, this here, like that it popped almost 40 points on the roll. Really kind of, it skews the smaller degrees when you look at it there, because on the regular continuous that's not back adjusted, we actually haven't made a lower low yet from June. So I switched over to this chart. But yeah, I do think that we can head up towards the 2,500 region.
Awesome. Well, I think a lot of the gold bugs would love to see that. So, and you know, the wave counts that I've seen from people that follow your type of analysis, see one more low below the 1880s, down towards 1850 before rallying into new highs. It's gold's, I think universally what I'm hearing is most people are looking for a bullish move out of gold, after this corrective move right now that we're seeing.
Right. Right.
Well, interesting.
I'm definitely not going to fight. I'm definitely not going to fight a move down to the 1880s or 1840s, but I don't know if it's needed. So I'm going to be looking closely at the small degree wave structure, off of the low here, and see if we do in fact get a small degree 5 waves up and 3 waves back to form a bullish small degree 1-2, and then keep tracking that and see where it goes, as long as it's going to hold support.
Right. Well, Zach, I apologize that Dale wasn't able to be here today. The once in a century hurricane that hit the west coast of the United States obviously had an effect on Dale. But I want to thank you for being here with us today, and I hope you join us again here on the F.A.C.E show. And I'm sure Dale will be reaching back out to you. But I want to ask you real quick, what's the best way for traders to follow your work at what you do at Stockwaves?
So go to ElliottWaveTrader.net and sign up for Stockwaves there. We post some stuff we post articles on Seeking Alpha, free articles on Seeking Alpha. At least I guess they're free for the first week or so, and then Seeking Alpha sticks them behind their paywall, which kind of seems a little bit counterintuitive to me, but anyway. And then also on Twitter at ZACMANNES. So I try and post a couple things a day on Twitter. And it's not just like teasing the analysis that we're doing in actual Stockwaves. I try and share some real stuff there too. And also just try to have a little more fun.
Awesome. Well, hey Zach, I'm gonna I'll reach out to you separately. I'll bring you in on Trader Summit one of these days, and we'll do a little bit more in-depth analysis with you if you're up for it.
Absolutely. Thanks, Blake.
All right, Zach. Well, thank you so much for joining us today. And folks, I want to say thank you so much for spending your time here with us on the F.A.C.E show. And Zach, have a great day, great week, and enjoy the remainder of your August month. And everybody else, we'll see you tomorrow morning on the F.A.C.E show, bright and early.
Great. Have a great day.
All right, you do the same. Thanks, everybody, and have a great one. And we will see you tomorrow on the F.A.C.E show.